over the last 25 years, we showed a chart going back to 2000 where Bloomberg Commodity Index and the gold were measured against each other. And gold's now back at its all-time highs of the last 25 years. There was a period there when gold had doubled in price between its 2015 low and the mid-2020, summer of 2020 high. Went from 1,050 to 2,070, almost doubled. During that same time, Bloomberg Commodity Index was still going down. Commodities were not following gold. And then when gold paused for a couple of years there.
Good day, and welcome to Economy Express, your trusted source for breaking financial insights and market trends. Today, we bring you a headline that could redefine the future of precious metals.
It frustrated everyone. Went into a range that was at max 20% wide, but most of it was about 15% wide. Bloomberg exploded. So the Bloomberg versus gold spread collapsed versus gold. So gold underperformed during that period from about 2022 to early 2024. Now has exploded back up again, back to its all-time highs, gold versus commodities. But it's our technical assessment and fundamental assessment that the commodity complex will be a place that exiting money from the stock market will be going. And I don't mean going into corn futures and oil futures, but into stocks related to those commodity markets, like oil-related stocks, base metal-related stocks, agricultural-related stocks like fertilizer and so forth. There will be a place to go. So if you're looking for an alternative place within the stock market, I would be looking at commodity-related sectors, and particularly, I think, ag sectors, agricultural-related, would be a best place. Then there's the issue of the gold miners, the dogs, gold and silver miners, and it traces back to 1986 that index. So it's also not an ETF; it's not traded as such like GDX is. But if you measure that index from its bare low in 2015, coincident with when gold made its low, it's gone up like 120% at current price levels. It's actually, since the S&P, it beats the S&P, but nobody notices this marginally. But it beats the S&P over the same span of time. And yet it's hard to believe that, but you can actually measure it. But when you look at the long-term charts of the gold mining sector, the price charts, but especially when you look at its valuation versus gold, the miners, how cheap are they versus an ounce of gold? Or how expensive are they? Right now they're on the floor, okay? And they've been there since 2015. Not been losing ground. The miners have held their ground since 2015 on a percentage basis. They've gone up about as much as gold, if a little more. But they'll accelerate to the upside at some point. And that point will be, especially when people in the stock market say, hey, I got to get out of this thing. I need to buy some other kind of stocks. They're not going to go out and buy gold, silver futures and use leverage. And they're probably not going to use double long ETFs of bullion. They're going to go for the gold miners and silver miners. And since that's such a tiny little sector and it's so undervalued, not only in relation to gold, but in relation to the S&P. It won't take much money flow, the blood flowing out of the stock market into some other category to boost the gold miners off the page because they're such a tiny little asset category. And we expect to see that in 2025, where suddenly the perception that miners are dogs that, lag gold all the time, they don't sometimes.
Market analyst Michael Oliver predicts that silver is on the brink of one of the most massive price rallies in history. Could 2025 be the year silver finally takes center stage? Stay tuned as we uncover the driving forces behind this extraordinary forecast and what it means for you as an investor. For the past 25 years, gold and commodities have had a complex and ever-shifting relationship.
They'll go into a leadership position, and I think that's probably going to be the best place to be on the planet, is in gold and silver miners in 2025, because they're monetary, they're money. But even raw commodities like copper, let's say an industrial metal, looks poised to go up while the stock market goes down. Now, if you go back and look at the late 70s, we had stagflation. Economists couldn't figure it out. How can you have inflation and yet collapsing, a wasteland in the stock market for a decade almost? And yet commodities exploded all during that time, the 77, 78, 79, and 1980. They went up with gold, not as much, but they went up strongly. And yet we're in a global recession. So the examples that people remember, they're burned in their memories, are very isolated instances where gold temporarily had a bad month along with the stock market. I caught the crash in 87. I didn't catch it in a big way. I caught it in a small way, but I did it with puts. So I got my customers in it as well. I was a futures broker. And I learned a lesson. But during that collapse, and gold wasn't even in a dynamic market at that time. It wasn't, you wouldn't define it as a super strong bull market. But the stock market collapsed. Gold went up 10% that week. Same week that stocks went down 30-something% and went up 10. Okay. So, but you go back to that 2008, 7-8 bear market. In October of 2008, there was a crash type event in the stock market, but it was a full year off its high. It had already been in a bear trend since September, October of 2007. So in October of 2008, way off the price high. And gold at that point had been rising sharply in that period of time. But suddenly in August, September, and especially October, gold had a relapse. It needed to have a correction. It was technically ripe to have one, but it lasted basically 1 month where it was doing the same thing as the stock market. And then the stock market continued down until March of 2009. Gold was back at its highs by then. People ignore that. So yes, there was a 1 month phenomenon. Also, COVID event was another time, but they're isolated events and they're not part of major trends. They're hiccups. And yet people seem to have that only in their mind, not the major trends. And if you go back and look 2000 to 2002, major bear market, .com collapse, gold was up all during those years, okay? And from 2000 to 2011, gold had a massive up move had an interruption in October 2008. But during that same period of time, the stock market was not performing well. It was in a lateral position since its 2000 high. In fact, it took it, after the 2000 peak, it took the S&P 13 years to finally go up and exceed it and move on up. It was until 2013. For the NASDAQ 100, after it peaked in the year 2000, it collapsed, and it was 16 years before it could ever get back to the price high that it had seen in 2000. So if you factor in, if you didn't get out in 2000, and by the way, MSA put out a major sell signal in January. Yeah, it took it about a year to collapse, but it finally did. But it took it 16 years. Imagine not having gotten out and not gotten long gold during that time. Gold was very cheap then, year 2000. It went up through 2011. It took you 16 years to nominally get back to the price high you saw in 2000. I say nominal because the degradation of money over that 15 years, the real buying power, collapsed big. Because, the money supply almost doubles every decade. So you've got to keep that in context. A lot of people are too focused on one minor event here and one there. They isolate and they don't see the...
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Michael Oliver highlights a key observation. Gold has surged to near all-time highs, while commodities have lagged behind. Between 2015 and 2020, gold prices nearly doubled from $1,150 to over $2,070, yet commodities remained subdued. But now, gold is once again asserting its dominance in the financial world, prompting investors to rethink their portfolios. So, where does capital move from here? Oliver believes the answer lies in commodity-linked stocks, oil companies, base metal producers, and agricultural firms, particularly those in the fertilizer sector. These sectors are poised for significant gains as institutional investors seek alternatives to an overinflated stock market. Among the most undervalued areas of the market is the gold and silver mining industry. Investors have largely overlooked these stocks, but history suggests that their time for resurgence is approaching. The Barron's Gold Mining Index, BGMI, tracking the industry since 1938, reveals a surprising fact. Since the 2015 bear market low, mining stocks have outperformed the S&P 500, gaining over 120%. This contradicts the long-standing belief that miners always lag behind physical gold. Instead, when measured against gold itself, mining stocks are at historically low valuations, creating an incredible opportunity for early movers. As institutional investors exit traditional equities, gold and silver mining stocks could skyrocket, fueled by increased demand and their relatively small market size. Even a minor influx of capital could send these stocks soaring. Now, let's turn our attention to silver. Michael Oliver's analysis suggests that silver is one of the most undervalued assets in the financial system today. Historically, the gold to silver ratio has averaged around 16 to 1, yet today it fluctuates between 75 to 1 and 85 to 1. This extreme disparity signals a vast upside potential for silver. Unlike gold, silver has significant industrial applications. It's essential in solar panels, electric vehicles, and advanced technology. Demand continues to outstrip supply, creating a growing structural deficit. Yet, despite these bullish fundamentals, silver remains suppressed. But markets cannot suppress reality forever. As investors recognize silver's true value, we could see a price rally reminiscent of past historic silver booms. Investors who position themselves now could be in for unprecedented gains. Beyond supply and demand, geopolitical shifts are also setting the stage for silver's rise. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively challenging US dollar dominance. By accumulating gold reserves and reducing their reliance on US Treasury bonds, these nations are laying the foundation for a potential gold-backed trade system. If BRICS implements such a system, demand for silver could surge alongside gold. Meanwhile, central banks worldwide continue stockpiling gold at record levels, quietly preparing for what could be a major monetary reset. The question remains, if gold and silver are not essential, why are the world's most powerful financial institutions hoarding them? The answer is simple. Gold and silver are real money, and those who grasp this truth will have a strategic advantage. Looking ahead, all indicators point to 2025 as a potential turning point for silver. Michael Oliver emphasizes that the financial system is undergoing a profound transition, and those who fail to adapt risk being left behind. Central banks, sovereign wealth funds, and high-net-worth investors are already moving into gold and silver. The financial elite understands that fiat currency devaluation is accelerating, and they are positioning themselves accordingly. The question is, will you take action before it's too late? If history is any guide, silver is overdue for a breakout. The fundamentals are in place, the market is tightening, and geopolitical forces are aligning in silver's favor. Investors who act now may find themselves on the winning side of one of the greatest financial shifts in modern history. So, what does this mean for you? The financial landscape is evolving rapidly, and silver's potential has never been greater. If you've been waiting for the perfect moment to invest, the time is now. Do you believe silver is on the verge of a historic price rally? Share your thoughts in the comments below. If you found this report insightful, be sure to subscribe to Economy Express and hit that notification bell for real-time updates on the financial world. Thank you for joining us today. Until next time, stay informed, stay prepared, and stay ahead of the financial curve.